Hello traders and investors. Today I'll be rather cynical and I will explore, I would say better explanation would be I will give you a glimpse or insight into ways how we delude ourselves, and I will give you some relatively simple but like understandable examples of ourselves, how the public general itself and even us ourselves are fooling ourselves in financial markets. So I don't know whether you are aware of that, especially if you are not that good English reader. There is a quote, there is a sucker born every minute. Now, it's associated with this guy, P.T. Barnum, but probably it's not said by him, but the idea is simple. This, you, you read the quote, there's a sucker born every minute. That means that there will be unbelievable quantities, or I would say endless quantities of gullible and naive people, and they could be easily used as every kind of con, hoax or trickery that one might imagine. Now of course it depends of our own interpretation of what the con is. Some would say con is multi-level marketing scheme or some sort of folk medicine or NFTs or some crypto project. Others say that scam might be religion or taxes or something like that. So this is relatively blurry waters, but I don't want to go that far. I would say let's stick to financial markets. And in financial markets, people say that they are naive and dumb people who don't understand interest rates and they don't understand money itself, so it's very easily to fool them by giving simply blunt numbers with unrealistically high expectations and some false promises of confidence. And this is backed by other, not so theory, but sort of idea of greater fool theory. And what does it mean? Greater fool theory implies that there is actually no such thing as value in it, like objective sense, because you cannot measure it like you could do something in physics or chemistry. But the value is perception, and as long as there are people who are willing to buy something, you could be able to sell anything. So you could do that into stock market, you could do that in the I will use the example which I found in Wikipedia. Here is the example of art, here is the example of cryptocurrency. So the idea is this very simple. If you own stock and you see that it has really high hype, you could sell even more stock, because you could sell it for even more prices, the same stock, or you could buy an art, or you could buy real estate, and you could see if there is crazy mania. Doesn't matter how much is worth unless there is some fool who is buying it for higher worth. And this example was no more evident that it was in cryptocurrencies and things like NFTs, because if you wanted to see the like peak of delusion in recent memory, I think the bull market of 2021 in cryptocurrencies and particular in NFTs were particularly high. Well, my subjective opinion was that actually most of the people understand that this is delusion and they wanted to make quick money. So, but that's another story. So yes, this is the thing. We don't have, I will open this. There is also, if you want to read, you could just simply look at the thing called subjective theory of value, which effectively means what it says, that this is economic theory that explaining that value of goods and services are not only set up, but also they fluctuate over the time, and their value is based on perception and things like that. And this goes along with greater fool theory, and there is that the sucker is born every minute. So there are naive and gullible people who want to make quick money because they don't understand how financial markets work, so they buy into very highly priced assets. That could be anything. It could be art, it could be real estate, it could be cryptos, it could be whatever. And since there could be more suckers, because sucker is born every minute to buy it in, the value of the specific asset increases simply because people perceive it's high or it's valuable, and it goes to like self-reinforcing circle until there is no money or no interest, and it busts. And actually this is something as economic bubble told in other words, because I just described the idea how economic bubble develops from something which is fundamentally valid to something irrational. So you could see that, like, even Wikipedia has noted that 2021 was everything bubble. So everything that has any kind of value, whether it were real estate, stocks, crypto, went in higher prices or raised in its prices because there were simply too much money and too much hype for it. So this is the thing you have to have to understand. If you are into financial markets, you have to understand, like, are you the sucker? Because if you don't know or you are not aware of it, chances are that you are one of them. So the first thing is self-awareness. Aware that we could be living in delusion in this very moment, because if we are living in delusion, we are not aware of it. So whether it could be gold, whether it could be crypto or stock market or interest rates, whatever, not interest rates, but bonds which are priced based on interest rates and our perception of future interest rates, we have to understand, are we the suckers or could we be subject to some sort of speculative bubble? If we start to critically think about it, we have chances to mitigate risks that we could be buying into exactly the wrong time and lose our own money. So what I'm saying, in other words, let's open S&P 500 and say, if there is a sucker born every minute, and if stock market or any kind of asset prices are simply subjective things which are based on greater full theory, and we are now living into economic bubble, ask ourselves question, are we not at risk to buying here? That's the question. If we are aware that we could be fools, we could be very subjective of ourselves, and even if we are here, we could make strategies that could make us money when markets collapse, or at least mitigate the risk and invest in long term via dollar cost averaging or proper diversification. So understand that we could be fools and anyone could be fool. That's first thing. And that secondly, short term, especially in short term, any kind of asset prices could be priced simply on people's perception of value. Also, of course, they are kind of placed based on people's perception of value anyways, but let's take simplicities. Understand that it could be like height of bubble. So if it's so, how we could act if something collapses and we are fools that don't know nothing. If we start thinking these terms, we would greatly reduce our possible risks of losing money. And that's the thing about these theories. It's cool to look about read about market delusions and how irrational or how subjective we are, but we have to think that our own decisions and our everyday actions could also make us subject of these same things. So if we start to invest, we have to understand that firstly we could be those guys ourselves. So mitigate this risk by awareness and have a plan for contingencies. Doesn't matter where you invest and what you do. You could buy a house for your retirement, you could invest in bonds, you could invest in stocks, or you could trade, and understand that you might be the fool, and if you are, how you could avoid the risk of being conned by yourself. And that's the thing about markets. That's the thing probably every investor and trader who is successful thinks about it. In other words, it might sound as risk management, yes, but we could look at the markets from quantitative perspective and say that we have to be risk managers and we have to diversify properly to avoid any kind of market downturns that goes against us. And we could be more philosophical and say that we might be fools, and how we are fooling ourselves and how we could mitigate our own foolishness so we don't lose money. That's another question. So on this rather abstract note, thank you for listening to this video or watching it, depends how you see it, and till the next one, bye.